Hi, everyone. It's John Pocaroba. It's April 23rd, 2022, with my general market update. This is the third week in a row of an update. There's just a lot of really important things going on in the market. So I decided I'd put out another update this week. So just as a reminder, the presentation is made by Rain King LLC for educational purposes. I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. So these are the 4 points that we're going to talk about. The big picture again, to give it context, the indices, the Fed, and as well as a revisit of the bull market in commodities, taking a look at 2008 and today. So the big picture, this is the NASDAQ, a daily chart as of April 22nd. Just marking some key levels that I have shown in the past. We're still at that point where we're trying to understand if this is going to still remain a bull market correction, as by my definition, or we are actually going to get into a major bear market. It's certainly becoming a case of critical juncture. Monthly chart of the NASDAQ. I've shown this before just to put in perspective some major long-term trend lines. And the point was the NASDAQ could come all the way back down to the 11,000 area, plus or minus, which is about a 31% correction, and still be in the super cycle thesis that I've talked about in other videos. So let's get into the indices a little bit. NASDAQ on the left and the S&P on the right. The NASDAQ, as we noted last week, had broken the follow-through day low. Things actually have gotten worse. They're rejected at the 50-day, and Thursday and Friday were some intense, steady selling in all of the indexes. And it certainly looks like we're going down to test the early March lows. As a reference point, this is where the 11,000 area is. It's an area that I mentioned in that long-term chart. Now on the S&P, again, the Fed talk on Thursday and Friday really hit the markets hard all the way across all groups and industries. You know, this low that was established in late February on the S&P is likely to be tested. If it undercuts, that would mean the rally that was part of the follow-through day number 2 that occurred in March would be officially dead. So we've talked a little bit about, you know, is this a correction or it's a bear market? I had mentioned a few months ago, there's been 23 bull market corrections in the S&P and 6 major bear markets since 1971. There's some statistics on those. But right now where we are is the S&P is corrected 14.6% in 108 calendar days, where the NASDAQ is already below 20%. It's off 22.5%. As I mentioned, the first follow-through day failed on February 23rd. It undercut its initial low. Now the second follow-through day has not yet failed, which means undercutting the low. So at the moment, it's still a bull market correction on the S&P. Now, based on data that I keep, when you get 2 follow-through day failures within a 3-month period, that's typically led to a deeper major bear market, which I define as, you know, in the 40% range or more. Now, there's one exception that I'm aware to this rule, and that was in 2015-16 correction, where we did have 2 follow-through days that undercut, and we did not result in a very deep bear market. So this is the weekly chart of the NASDAQ. Things definitely look pretty bad. We had a really terrible week, outside week, closing at the lows. We're very close to the lows I had mentioned. And we had talked a couple weeks ago about this bear market rally attempt. You'll notice how it rolled over as well. This is actually the 2008 market in blue. You'll notice that that market sold off hard, and it actually, everybody thought that market was going to break really hard here, but it actually had one more bear rally of about 14% over 5 weeks, still ran into overhead resistance at the 200-day, and eventually broke wide open. So we just have to be alert in both directions. Coming back to my 2011 precedent, I just wanted to kind of grade out everything that is kind of in the past that we've referred to in the precedent, and where could we possibly be today? You know, in 2011, we had a couple rallies up in the 200 that got rejected. And you'll notice that, you know, the last of those rejections had a very swift, sharp sell-off, like we're experiencing now. Now, you'll notice that in 2011, things did reverse very quickly and had a V-typed shakeout. We don't know what's going to happen. Again, this is just a reference point. But in 2011, we actually held the lows and things turned around unexpectedly. So we have to be open to anything can happen. Because we know that in 2018, we had a couple thrusts lower, and we were in a bear market there, which had 3 distinct lows. So we could be in this scenario, or maybe the 2011 scenario. I showed this last week, which was about the inflation data going back, and the Fed, how they had to raise rates. And I talked about, you know, little quarter-point increments are probably not going to get it done to deal with inflation. And it looks like this week, Thursday and Friday, you know, the Fed made very hawkish comments that they're going to be really aggressive about rate hikes. And obviously the market is reacting to that and trying to adjust to that. The reality is the Fed has very few tools, not many tools in its toolbox right now, and they are clearly making the priority to attack inflation. And it sounds like they're going to be pretty aggressive about it, because it even affected all of the commodity stocks to this aggressive tone. I guess the Fed is assuming that either the economy is strong enough to take significant rate hikes, or just hoping the economy doesn't tank, but it certainly is not at the forefront of their thinking at the moment. So I want to come back to commodity leadership. This is just the the market cycle and the economic cycle. I've covered this in previous videos. The point being, we are late in the economic cycle. But I want to pull up 2 charts that I think are important relative to commodities. This is the 2008 NASDAQ top, and I've also layered onto it the peak in commodities from 2008. So what I wanted to show you was the black line here is the NASDAQ, which actually peaked way back in November of 2007. And there was a bear market rally in the NASDAQ. It was a 9-week rally, and it ran into the 200-day line and got rejected. And the market rolled over. But you'll notice that during that period of time, these upper 3 lines, these are all the fertilizer stocks. And I've also included some metals and oils. And you'll notice that the metals and oils peaked well after the NASDAQ peaked. But what I think is interesting is, if you start to correlate, when did they peak in 2008? The metals and oil started to peak right after the first bear market rally. And it was a little later, about 1 to 2 months later than that bear market rally, that the fertilizer stocks, which were leaders, started to peak. So if you look at on a weekly chart, again, there's the rally, and the commodities were peaking, you know, in this 1 to 2 month period as the market had started to get rejected at the 200-day. So if you put that in your mind, from 2008 as just a placeholder, and we look at what's going on today, again, similar chart. The black line is the NASDAQ, which peaked in November of 2021, and you can see it trending lower. And we just experienced a 3-week rally that ran into resistance, a bear market rally into the 200-day. So I've shown that on the weekly chart here. And you'll notice that during the last few months, there's the commodity stocks that are really rallying strong. And now in the last couple of weeks, they've run into trouble, particularly this week with the Fed's comments. So the question is, you know, is this the peak in the commodities? It's happening, you know, about a couple of weeks after this bear market rally. So that's the big question. Is I thought it was an interesting correlation how eventually the commodities are going to peak out. So we'll have to see how it plays out, but I thought it was worth noting. The other thing we talked about last week was looking at the commodities for topping out signals. One of the things that we mentioned was look at the accumulation distribution rating. Now, in the past week, there's been some deterioration. Here's Arch. It went from a B- last week. It's a B today. BTU from A to B+, Mosaic A to B-, CF B+ to B-, Tech Resources is now a D- accumulation distribution rating. Oxy went from an A+ to an A. Alcoa, D-. Devon Energy is kind of a neutral C, but it's not good to see a C. We also said we wanted to look if there were going to be 10-week breaks on some of these commodity names to really give us some indication that they were under distribution. FCX, Freeport, and Alcoa both broke their 10-week moving averages on big volume this week. That's definitely negative. That's not a good sign. Now, Tech and Vale, they broke their 10-week moving averages, but they did it on average volume, kind of neutralish. And then there were others in the oil patch, Pioneer and Devon and OVV and SU. They're actually above or just at their 10-week moving averages on below average volume, which for the moment is still constructive. So it's a little bit of a mixed bag. We're getting some of the leading metals starting to break. So it's definitely an important time to pay attention. So there was some significant change that we experienced on Thursday and Friday with the Fed talk. All the major indices are below their 50 days, which is negative. The lows are being tested. So I do want to note, don't jump the gun. Everybody says, oh, the lows are going to be broken. They might be broken, but let's wait and see if they actually are broken. Sometimes when you get a lot of people putting stops around an obvious low in the market, all those stops will get triggered. There'll be a flush, and it's possible we will reverse the other way and rally. So another brief counter trend bear market rally might be a possibility. So try to stay open. You know, things aren't looking good. The commodities, we need to really keep our eyes on these because they could be topping out now, or possibly the true leaderships in the commodity names might gather themselves and have further to go. But the point is, it's a time to be cautious. You should be developing a plan. Number two, you should be following your plan. And number three, you want to play defense first. So I want to do a quick update on the straw poll. I really want to thank everybody who has responded. You know, I've gotten some really positive feedback, but at the moment, from all the people watching the videos, I don't have critical mass to be able to do these on a weekly or more frequent basis. So I'm going to say the poll is still open. If this is your first time watching one of my videos, drop me a note. If you're interested, if we get to critical mass, I'll make a commitment to doing these on a regular basis. Otherwise, I'll probably fall back into doing these, you know, every 3 or 4 weeks. So again, I want to thank everybody for watching today. There's my Twitter handle. Please subscribe to my YouTube channel for the general market updates, and spread the word to others if you want to see the general markets become a more of a regular feature that we can all look forward to. So thanks. I'll see you at the next video.